In the world of finance, the concept of risk is it's usually taught as something you can manage, something predictable.
Mm.
If you make a traditional investment, say you buy a stock or a commodity, your risk is capped, right?
It's capped.
If that asset goes to zero, the absolute worst case scenario is a 100% loss of what you put in. It's finite.
And that's the crucial asymmetry of buying an asset. You know your maximum downside, but your upside, well, theoretically, it's unlimited.
Okay, but when we flip that trade, when you become a short seller, betting the price will go down, the entire game changes.
The whole calculus is inverted. If the asset price rises, you lose money.
Yeah.
And because there's theoretically no limit to how high a price can climb, there is, by definition, no limit to how much you can lose.
Your risk isn't 100%.
Your risk is infinite.
Okay, let's unpack this idea, this unlimited infinite loss, because we've all watched it play out in, spectacular fashion recently. We're talking about the GameStop saga. Retail investors figured out that the big hedge funds had gotten themselves structurally over-leveraged in a short position. They saw the weakness, they mobilized, and well, suddenly Goliath was trapped.
The GME story is really the essential context for all of this. Those hedge funds were betting against a company, and when the price went parabolic, that theoretical infinite risk, it turned into brutal, very real margin calls overnight.
Billions of dollars.
They lost billions in days. It was just this historic transfer of wealth. And it was driven by a really simple mathematical truth.
Yeah.
A short seller is always, always exposed to infinity.
And the reason we're bringing this up now is that we're looking at that exact same mechanism playing out, but on a systemic global scale. And it's involving a strategic industrial asset, silver. Our deep dive today is centered on what you could only call a position of colossal arrogance.
It really is.
A handful of massive commercial banks are holding one of the largest concentrated short positions in financial history in the silver market. We're talking about shorting hundreds of millions of ounces.
And what's so fascinating here is just the sheer audacity of the bet. They've been suppressing the price of silver for decades using paper promises, and they got caught leaning too far forward.
So they were shorting it at what price?
They shorted silver aggressively at $30. They kept shorting it at $50. And now, with the price pushing towards, $79 an ounce, they are staring right down the barrel of that exact infinite loss scenario that just crippled the GME short sellers.
And this bet, it isn't just against the metal itself. It's a bet against the massive global push toward solar energy, electrification, high-tech demand, all the places where silver is absolutely essential.
Right. They're betting against the future of industrial demand. And they're betting against the retail investor. They're betting against you, who is waking up to this structural vulnerability they've created. The stakes they're colossal.
So the core thesis of this deep dive is that we're not just speculating about something that might happen. We're watching what the research calls a commercial signal failure in real time.
Yes, in real time. The major banks, the Goliaths of the commodity world, are structurally trapped. For years, they were the masters of the game, controlling the price psychologically with an endless supply of paper. But that control, it's vanishing.
And their impending failure, is what creates the opportunity, because these banks, they will eventually be forced to surrender. They're not just going to absorb these losses quietly.
No, their own contractual obligations, the regulatory pressure of margin calls, it will force them into the market as the biggest, most desperate buyers on earth.
And that forced buying happening at the worst possible time for them, when physical supply is exhausted, that's the definition of a melt-up.
A violent vertical price movement. This is the moment where the hunters become the hunted, and that theoretical infinite risk finally materializes. And it drives prices higher than anyone right now expects.
Okay, that is a powerful thesis. But the immediate pushback is always going to be the same. How do we know this isn't just, noise or internet speculation about market manipulation? When you're talking about positions this big, held by systemically important banks, we need hard evidence.
And that is precisely why we ground this whole discussion in public data. This isn't based on anonymous sources or whispers. The thesis is built entirely on the public. Weekly data released by the commodities regulator, the CFTC.
The Commodities Futures Trading Commission.
Exactly. We're talking about the Commitments of Traders report, the COT report.
The COT report. I love that you call it the insider's map, because that's really what it is for anyone who wants to understand the mechanics of the futures market.
It's the market's X-ray. Every single Friday, it gives you a snapshot. It breaks down precisely who is long and who is short across all these different contracts, in our case, silver futures. It removes the anonymity.
So anyone can see it.
Anyone. It doesn't matter how big or small you are. You can see the collective positioning of the major players. It's absolutely critical because it reveals the market's structural leverage.
And to read this map right, we need to know who the players are. How does the CFTC categorize them? What are the two main groups we need to track?
Well, the CFTC simplifies this really complex ecosystem into a few key categories. But for silver and gold, two of them matter most. First, you have the managed money.
Okay.
These are your classic speculators. Large hedge funds, trend-following strategies, CTAs, commodity trading advisors. They're the fast money. They're often leveraged, just trying to catch momentum.
So they're important for sentiment, but they're not the bedrock of the market.
Exactly. And then you have the second group, the one we're really scrutinizing today, the commercials.
The commercial.
Correct. And the commercials are defined as the entities that use the commodity for production, processing, or hedging some kind of commercial risk. Historically, this group includes miners, industrial users, refiners, and this is the crucial part, the major bullion banks who facilitate the physical trade.
And this group has always been called the smart money. Why? Why are they the smart money?
Because they have real-world, boots-on-the-ground knowledge of supply and demand. If you're a miner, you short futures contracts to hedge your inventory against a price drop. You're locking in a profitable sale price for the metal you know you're going to dig up.
Makes sense.
And if you're an industrial user, you're buying contracts to lock in a price for your future supply. So they usually position correctly at the market extremes. They sell high to the speculators and they buy low from them. The historical rule of thumb has always been follow the commercials because they almost always win.
Okay, so that's the historical rule, but here is the critical deviation that the current COT report is just screaming at us. The commercials are now net short hundreds of millions of ounces of silver. That's not just a big short position, that is structurally massive.
It is the moment the historical rule just breaks down. When we see the commercial category holding a short position this extreme, we have to start asking questions. We have to distinguish between a legitimate hedge and, well, a speculative bet that's just disguised as a hedge.
A legitimate hedge is the miner locking in future production. That's risk mitigation.
Right.
But the core of this concentrated short position, it's not held by miners who have silver in the ground. It's held by a handful of major bullion banks. So how is a bank's short fundamentally different from a miner's hedge?
And this is the heart of the commercial signal failure. A bank doesn't own silver in the ground. When a major bullion bank shorts silver, they're not hedging a physical asset they own. They are selling paper promises into the market.
Futures contracts, derivatives.
Unallocated accounts.
Yeah.
Often without the corresponding physical metal to back that contract up. They're just relying on the belief that they can acquire the metal later at a lower price, or more likely that the contract will just expire or be rolled over forever.
And when you sell a financial product that you don't actually possess, hoping to get it later, especially when the underlying physical market is already showing signs of a shortage, I mean, that's what we call a naked short, isn't it?
That is the textbook definition in this context, yes. These banks are using their position to effectively create supply out of thin air in the paper market, purely to suppress the price. It benefits their trading desks and, historically, certain industrial clients who want low input costs.
Right.
The authors of the sources we looked at, they use this powerful analogy to make the recklessness clear. They say, this is like selling fire insurance while the city is already burning.
Wow.
You can sell the policy, you can collect the premium, but when the disaster actually strikes, when physical delivery is demanded or the price spikes, you can't fulfill the obligation, and your exposure instantly becomes unlimited.
And that concentration of risk is everything. If this short position was scattered across thousands of little funds, the market could absorb a few failures.
Of course.
But the COT data shows this is concentrated among a handful of massive, systemically important banks.
Exactly. And that concentration means that if the current price of, say, $79 an ounce keeps climbing, hitting those shorts that were put on decades ago at $30 or $50, the losses are not just financial, they're systemic. Every single dollar that silver climbs is turning their paper profit suppression scheme into real, measurable, and potentially infinite losses for the very institutions that are supposed to be managing global financial stability. The COT report right now is showing us a structural map of a Goliath that is not only trapped, but has willfully put its own neck into the noose.
Okay, so we're all trained to follow the rule, follow the commercials. But if the price keeps rising and those shorts get squeezed, that rule breaks. We enter the realm of the commercial signal failure. It sounds dramatic, but why is it so rare, and why does this moment feel like we're in one?
It's rare precisely because these large banks have immense capital, influence, and regulatory power. They usually succeed in bending the paper market to their will. The commercial signal failure is the moment the market recognizes that paper manipulation can no longer hold back the brute reality of physical supply and demand. It's the moment where the short sellers, after relying on psychological warfare for decades, finally face a physical reckoning.
But I have to challenge that a bit. If the banks are so big, why wouldn't the regulators just let them roll the contracts forever, avoid a real reckoning? What stops them from just maintaining this paper illusion indefinitely?
That's a great question, and it really speaks to the limits of even systemic power. What stops them often isn't the regulator, it's the physics of the market itself. If the short position is too deep and too concentrated, a price move causes a chain reaction. It's called a margin call.
A margin call.
And margin calls are non-negotiable. They are rule-based events enforced by the clearinghouses, not by the banks themselves. They're like the market's immune system. And they often override any political or regulatory desire for, stability.
And we have concrete, recent evidence of market physics just overwhelming the paper power structure. Let's look at the historical precedents that prove this commercial signal failure mechanism is real.
We have two highly relevant examples where the banks, or similar large concentrated short sellers, completely lost control, and it resulted in catastrophic losses and market chaos. The first one was in the palladium market back in 2019.
Palladium?
Palladium, much like silver, is an extremely tight industrial metal. It's absolutely vital for catalytic converters in cars.
So what was the structural bet the banks were making there?
Well, according to the analysis, the banks were heavily shorting palladium when it was trading around $1,000 an ounce. They believed that through their paper market operations, they could cap the price and stop it from rising.
A classic paper suppression play?
Exactly. But the fundamentals were just too strong. Strict emission standards globally were driving huge demand for catalytic converters, while the supply from the major producers, Russia, South Africa, was constrained.
So the physical reality just ignored the paper. What happened to the price?
It didn't just rise slowly, it spiked parabolically. From their initial shorting position around $1,000, palladium went to an astounding $3,000 an ounce.
Wow.
The Goliaths of the bullion banking world, the ones who have been so aggressively shorting, they suffered billions in losses. They were ultimately forced to cover those paper shorts with real physical metal they did not have, which turned them into desperate buyers. It was a massive, expensive failure of that follow the commercials rule.
Billions lost on a single concentrated bet. That is a powerful lesson in short fragility. But the second example, nickel in 2022, that highlights the regulatory fragility, which is maybe even more relevant here.
Oh, the nickel crisis of 2022 is the poster child for what happens when a concentrated short position is financially threatened. In this case, it wasn't a Western bank, but a Chinese tycoon, sometimes called Big Shot in the financial press, who held this massive concentrated short position on the London Metal Exchange, the LME.
And when the nickel price started to move against this massive short seller, what was the market reaction?
It was violence, just pure violence. The market moved so violently, driven by a combination of tight supply and the panic from margin calls, that the price of nickel literally doubled in a single day.
100%.
In hours.
Think about that velocity. The Big Shot short was so massive and so underwater that its failure threatened the solvency of the entire clearinghouse system.
So what did the regulators do to protect the system?
The LME took the extraordinary, completely unprecedented measure of halting trading, and this is the most controversial part, retroactively canceling trades that had already happened during the price spike.
Wait, they canceled trades that already executed?
They moved the goalposts after the game was already over, solely to save the trapped short seller from complete ruin. This wasn't a minor correction. This was a complete breakdown of exchange integrity. And it proves that when the commercials lose, the system will break its own rules to save them. That retroactive cancellation is a serious, serious warning for any retail investor in silver. But let's bring it back to the core mechanism, the margin call. Explain exactly why the price of silver at $79 is creating this suffocating pressure on these banks.
Okay, let's just track their bad bets. They shorted at 30, then 50. Silver is now at 79. They're already deep underwater.
Okay.
Every single dollar the price rises from here forces an immediate, suffocating margin call. For the listener, a margin call means the clearinghouse is demanding that the short seller immediately post more cash collateral to cover their escalating potential losses.
And we're not talking about asking nicely. This is a legal demand enforced by the mechanics of the market.
Precisely. These are leveraged accounts.
Hmm.
As the mark-to-market losses grow, the ratio of collateral to potential liability falls below the required threshold. The bank has to post the cash instantly, or the clearinghouse liquidates their position automatically.
And given the sheer size of this, hundreds of millions of ounces.
Right. If silver hits $100, which is just a 26% move from here, the losses translate into tens of billions of dollars in collateral demands that have to be met in hours.
That is what the sources mean when they say the losses become existential. The collateral demands are so large and so sudden, they threaten the solvency of the institution itself.
It forces the ultimate surrender. If they can't meet the collateral demands, they face involuntary liquidation. And liquidation for a massive, trapped short seller. Well, that's the definition of the melt-up. They will have no choice but to cover their shorts. And to cover, you have to buy the asset.
And this is where the physics of the infinity squeeze really begin. You now have a handful of systemically important banks, the biggest financial entities in the world, all at the same time forced by a mechanical rule to buy millions of ounces of physical silver.
Not because they want to, but because they have to survive.
Exactly. And this forced buying is happening at the exact moment the market is showing profound physical shortages.
It's a closed-loop feedback mechanism. The bank's desperate buying drives the price up, which triggers more margin calls for the remaining shorts, which forces more buying. This mechanism is what creates that vertical, parabolic spike. They spent decades trying to suppress the price, and now they've guaranteed they will become the most desperate and influential buyers the silver market has ever seen.
So we have to ask the fundamental question again. Why? Why did these sophisticated institutions take this reckless, structurally doomed bet? It just seems almost negligent to expose yourself to infinite risk in a market where you know the physical supply is tightening.
The short answer is inertia and the illusion of control. For 40 years, from the 1980s through the early 2000s, this trade worked flawlessly.
Yeah.
Every time the price of silver threatened to rise because of genuine physical demand, the banks could always just print more paper silver.
More futures contracts, more
And
derivatives.
flood the market. It was a perfect psychological operation. They created a perception of infinite supply, even though everyone knew that physical metal is finite, right?
It's a mind game.
Exactly. They convinced the market that supply was endless by creating a paper supply that was literally endless. They dump hundreds of thousands of new paper contracts, diluting the impact of real demand, and just psychologically drive out the retail investors and speculators who didn't understand the paper market. Their core belief was they could always suppress the price long enough to avoid ever having to make good on those physical promises.
But time changes the game. As industrial demand just accelerated, particularly for solar and electronics, the physical metals started to drain out of the major trading vaults. And you can't maintain a paper lie forever when the physical shelves are bare.
And that's the disconnect that leads to the infinity squeeze. You can print paper contracts, but as they say, you can't print physical metal. That physical drain on the vaults, driven by global industrial demand and retail buying, means the paper promises are now ridiculously out of sync with the actual available supply.
Let's get granular on the numbers, because this is where the sheer mathematical absurdity really comes into play. What's the estimate for the paper-to-physical ratio right now?
Well, this number is subject to different ways of calculating it, but the estimates cited in the sources they're staggering. They estimate that the ratio of outstanding paper claims for silver futures, derivatives, unallocated accounts, compared to 1 real ounce of physical silver available in the vaults for delivery, it's exploded.
To what?
Analysts put the ratio conservatively at over 200 to 1, and some estimates push it as high as 500 paper claims for every 1 single real ounce of physical silver.
500 claims for 1 ounce. That's not a market. That's a recipe for chaotic, instantaneous failure when the music stops.
It is the game of musical chairs. When the music is playing, everyone feels secure holding their paper contract, their promise, their IOU. But when the squeeze is fully underway, when physical delivery is demanded or margin calls force liquidation, you have 500 people all at once trying to claim 1 silver chair. The supply shock is instantaneous.
And the moment that demand for physical metal exceeds the inventory, the price stops being rational. It's not about production costs or industrial use anymore.
No, it becomes a price driven by survival. And here is the devastating outcome. The 499 people who are left standing, they don't just lose their seat, they lose their wealth. Because the value of those paper contracts collapses when faith in the counterparty, the bank that issued the IOU, collapses.
Which brings us to the terrifying point.
This is the critical, terrifying point. The banks, by aggressively overshorting and issuing these naked paper claims, are currently holding the vast majority of those phantom paper claims. They are exposed to the maximum extent possible if those claims suddenly seek to materialize into metal.
So the infinity squeeze isn't just some dramatic phrase. It's the mathematical impossibility of fulfilling 500 obligations with one asset. And the banks are caught holding the bag when the chair is claimed.
They created the instability, and now they're forced to deal with the volatility they created.
And the beauty of this situation is that the driving force for this melt-up isn't just the math, it's the shift in retail conviction. This is where the GameStop analogy moves from being a simple comparison to, well, a strategic blueprint.
Exactly. The GME situation showed the power of collective retail insight. They realized the hedge funds were short 140% of the available shares, an obvious mathematical impossibility.
They realized the hedge funds had to buy the shares back eventually. There was no other way out.
So their strategy became simple. Buy, and most importantly, hold. They adopted the diamond hands approach, understanding that if they just removed the supply from the float, the price appreciation was guaranteed.
And it forced the short sellers to buy back shares at $400 that they sold at $4. It was the ultimate painful transfer of wealth.
The silver squeeze is essentially GameStop on a global, systemic level, but with critical enhancements that make the stakes much higher and the fundamentals much stronger.
Okay, what's the first crucial difference?
The asset itself. GME was a dying video game retailer. Its long-term fundamental value was questionable. The excitement was purely driven by the short squeeze mechanics. Silver, on the other hand, is a strategic metal. It's not just a speculative trade. It's irreplaceable in solar panels, vital for 5G, electric vehicles, high-tech manufacturing. The underlying fundamental demand isn't deteriorating, it's accelerating exponentially with the global push toward green energy.
Which means that even after the squeeze is over, silver still has profound, fundamental, long-term value. Unlike GME, which really just relied on the short covering to maintain its price.
Absolutely. And the second crucial difference is the victim. In the GME saga, the victims were, relatively large but still isolated hedge funds like Melvin Capital. It was a painful, expensive lesson, but it didn't threaten the global financial architecture. Here, the victims are the systemically important banks, the entities that underpin the entire global commodity clearing structure.
The sources are suggesting that if the silver squeeze runs to its mathematical conclusion, it could literally break the banking system's commodity trading desks. That is a threat to the global financial system itself.
It is, and this is why we have to issue the core warning here. Because the stakes are existential for the banks, the volatility will be extreme. They cannot afford to lose. And therefore, the response from the banks and the regulatory bodies, which historically have acted together to preserve stability, it will be swift and aggressive.
They will use every tool at their disposal to shake out the retail holder.
Every single one.
So let's detail the expected countermeasures. If you're positioning for this, you have to be prepared for the battlefield to change rapidly.
We should expect 3 primary lines of attack, mirroring what we've seen in crises like nickel and GME. First, we will see immediate and drastic margin hikes. They will make it prohibitively expensive to hold any remaining paper silver positions, futures contracts, leveraged ETFs, and that will force leveraged speculators to sell, creating artificial selling pressure.
So they weaponize the financial requirements to force people out of their paper positions.
Precisely. Second, be prepared for trading halts. Just like the LME nickel crisis in 2022, the exchange might simply stop trading for days, maybe even weeks, to give the shorts time to reorganize, find a bailout, or exert political pressure. It's a tactic designed to just freeze the momentum and demoralize the buyers.
And the third, and maybe the most insidious countermeasure, will be the media campaign.
Yes, massive negative media coverage, the hit pieces. The narrative will instantly shift from investing opportunity to dangerous bubble manipulated by naive retail investors.
Right.
They'll declare that the smart money is selling, the fundamentals are weak, the price spike is temporary, all of it designed to create panic and break the conviction of the diamond hands. They need you to sell your physical metal back into the market at a low price to save their own colossal mistake.
Which just emphasizes that this battle isn't just financial, it's psychological. The aim is singular. terrorize the retail investor into surrendering their physical holdings, saving the banks from facing the physical shortage they created.
And this brings us to the crucial discussion of counterparty risk. The potential success of the squeeze, the price spike, is also what triggers the potential failure of the commercial banks holding the naked short position. This is the double-edged sword that can destroy the unprepared retail holder.
The listener might be thinking, great, I want the banks to fail, they deserve it. But if you are positioned through the wrong mechanism, you could lose everything when that institution collapses, even if the price of silver is spiking.
That is the crucial, often overlooked danger for the little guy. What happens if a major bullion bank, one of the entities trapped in this naked short position, fails due to tens of billions in losses and unmet margin calls?
If that bank collapses, anyone who has assets held with that bank is exposed to counterparty risk. And this applies most dangerously to those holding silver in paper forms, particularly the unallocated account.
We need to define the unallocated account meticulously here. When you buy silver or gold in an unallocated account, you are not buying specific segregated bars with serial numbers that belong only to you.
So what are you buying?
You're giving the bank cash, and they're giving you a general promise, an IOU, that they will give you silver if you ask for it. Legally, you are not an owner. You are merely an unsecured creditor to the bank.
And when a systemically important bank goes into bankruptcy or resolution, being an unsecured creditor is the absolute worst position to be in.
The absolute worst. The moment the bank enters resolution, it activates the bail-in mechanism. This mechanism, which was formalized globally after the 2008 crisis, is designed precisely to handle the failure of a sci-fi, a systemically important financial institution, without triggering a tax bank-funded bailout or a bailout.
So instead of the government providing cash, the bank uses its internal liabilities to recapitalize itself, and those liabilities include
the unallocated accounts. That's the cold, legal reality. The bank can legally seize or utilize that unallocated silver the IOU gave you to pay off its other, more senior debts, like debts to other banks or secured creditors.
So your promised silver is now collateral for the bank's failure.
Exactly. You, the unsecured creditor, are forced to take a loss, a haircut, which means your claim on the metal is converted into equity in a now bankrupt institution, or it's just simply written down.
So someone could watch the price of silver spike from $79 to $200, feel like they've won the squeeze, but still end up with nothing because their custodian bank failed and bailed itself in using their claim.
That is the essential, devastating takeaway. To successfully navigate and win this fight against Goliath, the listener has to completely remove the counterparty risk from the equation. The fundamental, unshakable rule of this squeeze is, if you don't hold it, you don't own it.
Physical metal in your possession.
The physical metal in your direct, private possession, outside of any bank or institutional vault, is the only asset that cannot be seized, bailed in, or canceled by a failing paper institution. It is your shield against systemic failure.
I think we need to emphasize the distinction here. For anyone who's been buying ETFs or digital metal products, even some of the biggest, most liquid ETFs rely on these very same bullion banks as custodians.
That's a critical point.
If the custodian fails, the ETF might have real metal, but accessing it during a bank resolution becomes a complex, multi-year legal nightmare. You're exposed to the very same risk.
You've hit on it. The chain of custody is paramount. Even if an ETF claims to be backed 100% by physical, if that physical is held in a pooled, non-segregated vault at a bank that is also shorting the metal and fails, the risk of legal lockup or conversion is immense. The true diamond hands position requires fully segregated ownership or, even better, physical possession. You turn the IOU into an asset under your control.
Okay, so we've established the trap, the mechanics, the psychology, and the absolute necessity of mitigating this counterparty risk. Given this high-risk, high-reward environment, this systemic David versus Goliath battle, what is the smart money playbook for the listener who wants to participate without getting taken down by the inevitable counterattacks?
The playbook has to be aggressive, disciplined, and above all, focused on the physical reality of the market, not the paper game that the banks control. It really involves 3 distinct strategies based on your risk tolerance and how you allocate your capital.
Let's start with strategy 1, the core squeeze tactic. This sounds non-negotiable for anyone who wants to actively participate in defeating the short.
Strategy 1 is simple. Physical is the weapon. Buying physical silver, whether it's coins, bars, rounds, is the only way to squeeze the shorts because it removes real supply from the market. Every ounce removed from the system increases that mathematically impossible ratio of paper claims to physical metal. It just dramatically raises the pressure on the bank's short position.
And I think we need to reiterate why this is so different from paper trading. Why does buying a silver futures contract actually undermine the squeeze while buying a physical coin fuels it?
Well, when you buy a futures contract, you're typically trading on the exchange floor, inside the paper system that the banks effectively police. You are adding liquidity and volume back into the bank's casino. And this often provides the banks with the very leverage and volume they need to maintain the illusion of supply. To win the squeeze, you have to change the battlefield entirely. You have to convert paper fiat currency into a physical asset that the bank needs to survive but cannot legally create. When you buy physical, you force the dealer or refiner to drain a vault, and that directly impacts the commercial's ability to find metal when they get that margin call.
Okay, so strategy 2 focuses on speculation with leverage. This is for the portion of capital that you are prepared to lose entirely if the game gets rigged.
Right. This involves call options. For the speculative segment of your capital, you could consider buying long-dated, out-of-the-money call options, either on the metal itself via a trust with low counterparty risk, or, as we've talked about before, on the well-positioned, leveraged silver miners.
And these options give you the right, but not the obligation, to buy the asset at a predetermined price.
Exactly. If the price goes parabolic, your small premium investment can yield exponential returns.
And the risk warning here, it has to be emphasized in neon lights.
Absolutely. The risk is 100% loss of the premium you paid. This is capital earmarked specifically for high-risk speculation. If the banks and regulators succeed in their counterattacks through prolonged trading halts, retroactive trade cancellations like in nickel, or by moving margin requirements so drastically that the option expires worthless, you lose every penny you spent on that option. This is a volatility bet, and you have to be mentally prepared for the zero outcome.
Finally, strategy 3, the exit strategy. This is maybe the most difficult part psychologically because it requires discipline to sell when everyone else is shouting about $1,000 silver.
Oh, discipline is paramount. A short squeeze is defined by a spike, not a plateau. It is short-lived, and it is vertical parabolic when the banks are forced to cover. The goal is not to hold silver forever. The goal is to sell into the panic buying of the banks and hedge funds when they are compelled to cover their positions to survive.
You're selling to the desperate.
You're selling to the desperate. So when are they most desperate? What signals the moment to execute the exit strategy? The sources suggest you have to be prepared to sell when the price achieves that vertical velocity that signals the forced covering is underway. If silver hits $150 or even $200 an ounce in a single week, a rapid nonlinear move, that is the clear signal of systemic panic.
That velocity is the sound of the banks being liquidated.
It is. You sell some, you secure your profit, and you allow the banks to eat the losses they created. Don't be greedy, capture the moment.
And the final critical piece of advice for the disciplined investor who has captured that wealth, what's the pivot?
You don't try to ride the asset back down because the crash that follows a parabolic spike can be just as swift. The smart move is to immediately pivot those profits into undervalued, non-paper manipulated assets. The sources specifically mention assets like productive land or other strategic metals like platinum, which are fundamentally sound but haven't participated in the volatility yet. You transfer the wealth captured from the failing paper banking system into secure, tangible assets outside of that volatility vortex.
Okay, let's summarize this entire investigation into the bank squeeze. We've moved beyond speculation, and we've confirmed 3 core facts using public COT data and historical precedent. First, the banks are trapped in an uncovered, naked short position that threatens existential losses for them if silver crosses $100.
Second, the physical market is structurally empty. This leads to a mathematically impossible ratio of paper claims to real metal, which means any attempt to cover will trigger a violent melt-up. And third, the price is currently rising, which is putting increasing, suffocating pressure on margin calls every single day. The trigger, it's been pulled.
So the smart money playbook for the retail investor for David is clear. Identify the trap by continuing to read the COT report weekly. As long as that commercial net short position remains historically high, the fuel for the squeeze exists.
And expect dirty tricks, the volatility, the margin heights, the media hit pieces. They will try every mechanism to shake you out.
Hold the line, because physical ownership is power. They need what you have, and you must protect it from counterparty risk. And finally, sell the spike. Don't fall in love with the asset. Capture the profit when the banks are at their most desperate and forced to buy.
This truly is a David versus Goliath scenario. It's GME on a systemic level. The future really belongs to the owners of the physical metal.
But we have to conclude with the ultimate sober warning, one that ties the financial reality to the political reality. When the banks lose, especially the systemically important banks, they don't just stand up, shake the dust off, and accept the loss.
No, they don't. They use their immense political and regulatory power to change the rules of the market retroactively to save themselves.
Indeed. You have to position yourself not just to win the fight against the price manipulation, but to insulate yourself from the inevitable regulatory blowback that's designed to save the financial system at your expense. They might demand retroactive trade cancellations, increase capital requirements for holding physical, or even move to close the paper markets entirely. You have to win the battle and then survive the subsequent war of regulation.
It leaves us with this final provocative thought to explore. The banks are currently short hundreds of millions of ounces they don't have, forcing them to become the biggest buyer on Earth. What happens when they finally run out of counterparties? When there is no one left willing to sell them the metal they desperately need to survive, and the market realizes that every last ounce has been claimed by the diamond hands.
That is the moment where the free market, finally unshackled by paper promises, determines a price where the commercial short position finally, completely collapses.